Hi all, welcome to this session. In this today's session, we are going to cover corporate bonds. So in the previous discussion, we already discussed about the stocks and now we are going to corporate bond. So as you remember, we started the second chapter of CMA USA part 2, that is corporate finance, where we talked about risk and return, then we come to long-term financial management. Then now in the previous discussion, we discussed about the stock, shares, both the preferred and common equity. Then we are going to corporate bonds. Corporate bonds is a financial instrument which is a debt financial instrument. Again, in the view of an investor, it's a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or government. So once the bond is issued, when the company or the government require the fund, borrowed fund, so the corporation or the government can issue the bond. Again, it's a fixed income instrument, so it is not grant an ownership. It's a liability for the issuer and an asset for an investor. In the investor point of view, it's an asset. If you have an investment in the bond, it can consider as an asset as an investor. But for the issuer itself, it's showing as a liability. Again, it's not an owner equity. If you bought a bond of a company, you cannot become the owner of the company because it's not grant any ownership. So the relationship between the issuer and the investor is they promise to repay the principal amount at a specific date while making periodic interest payment along the way. So there are two promises are there. The first thing is it is to repay the principal amount at the end of the period. Again, there is a periodic interest payment of the periodic interest payment also. So these two are the promises between this borrower and the investor. So again, the legal contract. The bond indenture is a formal legal document that specifies all terms, conditions, and obligation in the bond issue. So bond indenture is a formal legal contract between the borrower and the investor, which mention the all terms, condition, and obligation for the bond issue. Again, there are some covenant also. That means some negative and some positive covenant. That means some covenant can limit the additional buyer or dividend payout. Maybe some bond covenant can be negative with related to borrower or the company. That can be limit the additional debt or the dividend payout. Actually, this is to protect the interest of the investor. That means that bond covenant is blocking the company to take additional debt, external debt, or paying dividend payout, some restriction in the dividend payout. There are some positive covenant also, some requirement, like maintaining a good financial condition or financial ratio, or to have a adequate insurance for the whole company. So there are some positive covenant also. So the legal contract, the bond indenture is a legal contract that specifies the terms and conditions along with the covenant. This covenant can be the negative and positive in terms of company. If the negative mean it can block some additional debt issue or additional debt or dividend payout in some cases. And also when it's come to positive, it's are mainly the requirements such as maintaining the financial ratios in a healthy financial ratios, or to have a proper insurance coverage to all the assets. So these things also will mention in the legal contract or in the bond indenture. Again, the trustee. The trustee is a mediator between the investor and borrower. Usually it's a bank. Again, it's at behalf of a bondholder to ensure the issuer compliance with the indenture. So the trustee will ensure the compliance with the bond indenture. So the investors can, if there is a trustee, so investor can easily invest in the bond because the trustee will ensure, and it's that independent third party which will act as a bondholder to ensure the issuer compliance with the indenture. Again, this trustee will monitor the covenant and coordinate action in the event of default to protect the investor interest. The trustees act as a protector of the investor interest. The trustees monitor financial covenant and coordinate action in the event of a default to protect the investor interest. Is there any default happen from the company's point of view? So the trustee will act as a protector of the investor interest. Here are some terms that is related with the bonds. First one is par or face value. The par or face value is the principal amount that will be paid to bondholder at the maturity. Most corporate bond have a standard par value of $100,000. So par value is the value which agreed to pay by the borrower to investor at the end of a maturity period. Suppose a bond issued for a 5-year. At the end of the 5-year, the company agreed to repay 500 per each bond. In this case, the 500 is the par value. That means that is the amount agreed to repay at the end of the bond period. So now the interest. Interest is the annual rate paid by the issuer to investor. It is normally expressed as a percentage of par value and typically paid semi-annually. It's based on the bond indenture. So the interest is the annual rate. It is fixed against the bond that has to be paid by the issuer to the investor. Then another term is maturity date. Maturity is the final date which the issuer must repay the par value. Term bond mature at once, serial bond mature at stages. So it is the final date on which the issuer must repay the par value. What is the agreed value? Now the calculation of the interest payment. The coupon rate is a standard interest rate. To find the periodic payment, it is multiplied by the par value by the coupon rate and divide the number of payment per year. Suppose if the par value is 1000 and suppose the coupon rate is 5%, just assume, then the periodic or yearly payment is $50. If you are paying 2 times per year, then you have to divided by the number of payment per year. If it is 2, then the 25, it is your payment value. So you can calculate the payment value. You have to fix the periodic or the yearly payment that you are multiplying the interest rate with the face value. So to calculate the payment, first thing you have to multiply the par value with the interest rate. So then you will get the yearly dividend. So to calculate the payment of interest, first thing the coupon rate has to be multiplied with the face value. So suppose the face value is $1,000 and your coupon rate is 5%, just assume. Then your annual payment is $50. Then if you are paying 2 times per year, then divided by 2, that is 25. So this 25 is your one-time interest payment. Then the fixed rate means there are 2 types of rate for the bond. Then the predictable cash flow for the issuer and investor. That means it's a fixed rate throughout the bond life period. But it's the variable rate. Suppose coupon rate adjusts based on some benchmark. There are 2 types of rate. First one is fixed rate. That means it is the fixed rate throughout the bond life period. But if in the case of a variable rate, the coupon rate is adjusting based on some benchmark. There should be some benchmark will set against some measures, some metrics. So to calculate the coupon rate or to calculate the interest rate, it will link with that metrics or to that benchmark. So this is how to calculation of payments is pretty simple. You have to calculate the annual payment by multiplying the face value into the coupon rate. Then you will get the total annual payment and you have to distribute that into number of payments. So now let's come into the classification of bond instrument. There are four categories of bond. Mainly, it is the first one is mortgage bond. Mortgage bond is it is secured by specific collateral. It is normally considered as a low risk bond. That means that bond value is already secured with some asset of the company. That means maybe some real estate or some machinery. So it is already collateral or it is already secured, collateral by the some real estate or some other collaterals. So normally it is considered as a low risk because there will be priority on claim. Is there any default happen? There is a priority on their claim because it's already collateral with some assets. The next category is debenture. Debenture is unsecured. It is by general credit. That means it is unsecured with the any of the company's asset. It is considered as a lower moderate risk. The mortgage bond is normally considered as a low risk investment, low risk bond, but the debenture are normally considered as a moderate risk because it is not secured or collateral with any company's assets. So any default happen, there will be no priority on the asset claim. Then the third category is convertible bond. Convertible bond is it is can be exchanged for common stock. That means there is a provision on that bond to convert that bond into common stock once a period complete at a specific period. So normally it will considered as a lower yield because there is already provision to convert that bond into equity once a period complete or some event happen. So that type of the bonds are called convertible bond. Then the callable bond. Callable bond are those bonds that can be recalled by the company once they required even before the maturity. Suppose the bond issued for 5 years, maybe the project finished it in 3 years and company have enough fund to repay that bond. So in this case, if it is callable bond, the company can recall that bond and liquidate that bond. So there is a heavy reinvestment risk for the investor in this case for the callable bond because anytime the company have a right to call back the bond and that time the investor have a reinvestment risk for the callable bond. Then the next category of bond, that is zero coupon bond. Zero coupon bonds are issued issued not against a fixed coupon payment. It is zero coupon. That means there is no periodic interest payment, but it is issuing lower than the par value or face value. Suppose the bond face value is $1,000 and this zero coupon bond normally issued maybe for $750 or $800. Anyway, it is less than the par value. So in this case, in the zero coupon bond, the investor return is the difference between the purchase price and face value received at the maturity. Suppose in this case, suppose the face value is $1,000 and the issue price is $750, then the balance $250 is the investor return. So this investor can buy this bond at $750 and sell this bond at $1,000 at the maturity period. So there is no coupon payment or periodic payment for this category of bonds. That will be called it zero coupon bond. These are some classification of risk related to bond. That means triple A normally considered as a lower risk and triple B is the moderate risk and C it is higher risk. These are some criteria, some benchmarking for the bonds for the by the credit rating agencies. So by these credit rating agencies, the investors can choose the right bond based on their risk preferences and the expected return. Again, the inverse relationship. So there is an inverse relationship between price of bond and the market interest rate. So normally what will happen if the market interest rate increase, investors may not prefer to invest in the bond because the market have a higher rate of return. So in this case, normally the bond price will come down But in the case of rate, market interest rate is reduced. At that time, the most investors will prefer to invest in the bond. So that time, definitely the bond price will up. So this is the inverse relationship between the market interest rate and the price of the bond. So it is moving the opposite direction. If the rates up, that means the interest rate is up, definitely the bond price will down, because to attract the more investment or to attract the investment, definitely the bond price will come down. But in the case of a market rate is coming down, definitely bond will automatically attract new investment. So that's why the prices are going up. Again, this sensitivity is measured by duration also. Long-term bonds are generally more volatile than the short-term loan, because in the long term there is a big chance to have a changes in the interest rate and market return rate. So based on that, long-term bonds are normally considered as more volatile than the short-term bonds. So this is just the relation between the market price and of bond and the interest rate. It is in the opposite direction. So just a summary of issuer view. If a company issuing the bond, what are the benefit the company have? The first thing is the tax shield. The tax interest payment is considered as tax shield or tax deductible when it's come to the tax filing or income tax filing of a company or corporation. So let's have a issuer view of on the bond. There are some financial benefit to issuer with related to bond. The first one is tax shield. Tax shield means the interest payment is tax deductible. If you are calculating net profit, before the net profit you will deduct all the interest payment. So you are going to pay the tax for only for the net profit. So what you are paying as interest, that can be as a tax shield in the financial records, in the income statements. So the first key benefit of issuing the bond for an issuer point of view, it is a tax shield. That means interest payment are tax deductible. Again, reducing the effective cost of compared to equity. That means any other type of equity investment like the preferred or common equity, it is not tax deductible. So, but in the case of interest payment, it is considered as a tax deductible expense. So this is the first financial benefit for the issuer point of view, that is tax shield. The second one is control. Again, bond will not dilute the current ownership. If you are issuing a bond to a bondholder or a investor, they cannot claim the ownership of the company. It is not the ownership, but instead of if you are issuing a stock, they can claim the ownership and they can dilute the ownership. So by issuing the bond, the current management can retain the full control of the firm. Instead of issuing the stock, if the companies issue the bond, the current management can retain the full control over the firm. So these are some two key benefits for a issuer point of view. Then there are two risks also there, key risks also there. The first one is financial leverage. Obviously, if you are issuing more bond, their financial leverage is increasing. So which may cause to magnify the return on equity, but also there is an increase in the risk as well. That means there is a bankruptcy risk. Again, if you are not able to generate enough return, still you have to pay the periodic interest payment, and in most of the cases your assets are collateral for the debt. So there is a leverage and there is a financial risk related to the bond issuing. That is, the first one is the leverage risk, and the second one is the obligation. That means it is the periodic payment that we called as coupon payment must be paid regardless of firm profitability. Even if the firm into loss, the periodic payment has to pay for the bondholder, not like the equity shareholders. So that these two are the two strategic risks related to the bond issuing. First one is the financial risk related to leverage, and the obligation, that means the periodic payment. So we are just going to summarize today's discussion. What we discussed about the bond, it is a debt financial instrument. Again, the legal indenture protection. There is some legal indenture protection to protect the interest of the investor. Then the market rate sensitivity we already discussed. The bond price are primarily driven by market interest rate. With the market interest rate increase, definitely the bond price will decrease. If market interest rate decrease, definitely the bond price will also decrease. So it is moving in the opposite direction. Again, the bond prices are driven by market interest rate. Then the credit rate. Again, there is a credit rate quality. There are some rating for the bond to help the investors to select the bond based on the risk and the return. Then the issuer advantage. For the issuer, bond definitely it is providing a tax shield, and also it is helping the company to raise capital without giving up the ownerships. So this is about some basic about the bond. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.